Good afternoon, everyone. Thank you for joining us this afternoon for this webinar. My name is Vanessa Seeley-Fisher and I'm a member of the standards team here at the XRB. So what we're doing this afternoon is having a look at the NZASB exposure draft that is going to propose amendments to RDR for Tier 2 for-profit entities. Just before we start, I thought I'd just introduce the XRB briefly. The XRB is the abbreviation for the External Reporting Board, and the External Reporting Board is an independent Crown entity with responsibility for developing and issuing accounting and auditing and assurance standards in New Zealand. The XRB's organisation structure is we have an organisation that is made up of a staff, and we have 3 boards. The XRB board is responsible for the financial reporting strategy and the running of the organisation, and the 2 sub-boards are responsible for developing and issuing accounting standards and auditing and assurance standards. So we are part of the NZASB, or the New Zealand Accounting Standards Board, and we set accounting standards. And the New Zealand Auditing and Assurance Standards Board has the responsibility for developing and issuing auditing and assurance standards. So what is the reduced disclosure regime? This is a reporting regime under the financial reporting framework where we have the same recognition and measurement requirements as full NZIFRS, but we provide some concessions for the disclosure requirements for the entities that qualify to apply this regime. So if you're reporting under this, you are applying NZIFRS RDR, or it's defined in XRBA1, application of the Accounting Standards Framework, as the Tier 2 for-profit accounting requirements. So this seminar is dealing with the financial reporting requirements for Tier 2 for-profit entities. Those entities are for-profit entities that do not have public accountability, and the for-profit public sector entities with total expenses of less than 30 million. And those entities elect to report in accordance with Tier 2 accounting requirements. Now, public accountability for financial reporting purposes has a specific definition, and that can be found in paragraphs 7 to 13 of XRBA1. So it's narrower than the usual meaning of public accountability. The NZASB has issued an exposure draft and an accompanying invitation to comment, and those 2 documents propose changes basically to the way RDR would be determined in the future. So it outlines a proposed RDR decision-making framework, and as a consequence of that new framework, the exposure draft then proposes changes to the disclosure requirements for Tier 2 for-profit entities. So the objective of this webinar this afternoon is to raise an awareness of the invitation to comment in the exposure draft, and to do that I'll outline the main proposals in the invitation to comment, and we would seek your feedback on the proposals in that invitation to comment and exposure draft. Now, the invitation to comment is only 40 pages long, and that includes the proposed framework and an example of how Australia proposes to deal with this. So if we have a look at the table of contents on the invitation to comment, we've got the questions for respondents, and this seminar is not dealing with those specific questions. It has an introduction, it has an overview of the invitation to comment, and that's what I will be focusing on in this presentation. Appendix A is the draft policy for determining RDR for Tier 2 entities, And then in Appendix B, we've got some examples of how Australia plans to deal with the disclosure requirements for Tier 2 entities in Australia. Okay, this is a joint project with the Australian Accounting Standards Board, or the AASB, and it's intended to result in a more robust approach to determining RDR going forward. Now, back in 2009, the then Prime Ministers of Australia and New Zealand signed a joint statement of intent, the Single Economic Markets Outcome Framework, and one of the objectives of that framework was that for-profit entities reporting in Australia and New Zealand should be able to use only one set of financial reporting standards and should only have to prepare one set of financial statements that would be acceptable in both countries. And we refer to that as trans-Tasman harmonisation. So in the for-profit space, we have a requirement to align with Australia and Australia to align with New Zealand as much as we possibly can. The NZASB issued the exposure draft in January, and likewise the AASB issued their exposure draft in January, and both exposure drafts have comment periods ending on the 26th of May. So I'd like to take this opportunity to encourage you to think about anything you might disagree with, the things you do agree with, and we don't necessarily ask you to comment on everything, but there might be particular things that you want to express your view on and provide us with feedback, and we really would appreciate that. Now, I'm going to ask that we please just deal with the questions at the end, and I'll just work through this. And we can come back to any questions. They will also be made, the slides will be made available on our website tomorrow, and also a recording of this webinar will also be available. Now, as I said on the previous slide, the presentation is based on the invitation to comment, so the paragraph references on each slide refer to the paragraphs in the invitation to comment. Right, if this project progresses, and that depends on the feedback we receive, we propose that the new proposals would be effective for annual periods beginning on or after 1 January 2019. Early application is permitted, but not before 1 January 2018. And that is because the disclosures in the exposure draft include the disclosures added into NZFRS 7 as a result of NZFRS 9, and NZFRS 9 is effective from 1 January 2018, so it's not going to work before 1 January 18. Another limitation on the early application is that if an entity wants to apply the amendments to NZIS 40 investment property early, the entity must apply NZFRS 16 early, and that's because NZFRS 16 made fairly substantial changes to NZIS 40. Okay, the current, just briefly for to explain how we currently determine RDR. This is based on the approach developed by the AASB in 2010 when they first introduced a form of differential reporting. So where the Tier 2 recognition and measurement requirements are the same as the IFRS for SMEs standard, the disclosures are drawn directly from the IFRS for SMEs standard. So that means if, for example, the IFRS for SMEs has property, plant and equipment measured at cost, so the disclosures for measuring your PP&E at cost are the same as the IFRS for SMEs standard. If the recognition and measurement requirements are not the same. So for example, the revaluation model under IAS 16 for PP&E, then we've used the user needs and cost benefit principles applied by the ISB to try and determine what disclosures are appropriate for Tier 2 entities. Now the issue we've got going forward is the ISB has decided not to update the IFRS for SME standard for new and amending IFRSs. So it's getting very difficult to use the IFRS for SME standard as a starting point. So for example, we can't use it for NZ IFRS 15 and NZ IFRS 16. So that is one of the factors that has contributed to us doing this project. All right, now when we were the start of this project, some outreach was undertaken to try and identify the information needs of users. So outreach was undertaken in Australia with representatives of users of the financial statements of both for-profit entities and not-for-profit entities. In New Zealand, we did some very limited outreach with users of a Tier 2 entity's financial statements. The outcome of that outreach is that we've come up with a proposed RDR decision-making framework. That framework has two overarching principles: that the information disclosed by Tier 2 entities meets user needs, and secondly, that the benefits of providing the disclosures exceed the cost. To help us, I will discuss those two aspects in a little bit more detail shortly, but in addition to those two overarching principles, we've developed some operational guidance to help us to apply those principles. And the principles and the operational guidance form the RDR decision-making framework. So how does this framework work? We've identified some key disclosure areas to meet user needs, and they're currently split into two broad categories. The first one is dealing with the current liquidity and solvency of the entity. So we're looking there at the entity's ability to meet its short-term and its long-term commitments. And then secondly, we're looking at transactions and other events that are significant or material to an understanding of the entity's operations as represented by the financial statements. And that's quite a broad key disclosure area, so those disclosures are categorized broadly into disclosures of a general nature and then some specific disclosures where users told us that that type of disclosure is particularly important. So if we have a look firstly at the nature of transaction, the disclosures of a general nature, we've basically got four. We've got the nature of the transaction or event that makes it significant or material. So for example, we've got depreciation identified as the nature of a transaction. Second one is associated risks specific to a transaction or event, and a lot of those disclosures are found particularly in NZ IFRS 7, disclosures about financial instruments and the different risks around financial instruments and the risks that the entity is exposed to and how the entity manages those risks. The third disclosure of a general nature is about associated accounting policies on recognition or measurement, and although there is a general requirement in NZIS 1 to disclose significant accounting policies, there are also requirements throughout some of the standards sometimes to disclose a specific accounting policy. So for example, in NZIS 2, there's a requirement to disclose how your inventories are measured and the cost basis that was used to measure those inventories. And the fourth general sort of disclosure is dealing with the significant estimates and judgments relating to the nature of a transaction or event. So an example of those is in NZFRS 12 and paragraph 9, there's a requirement to disclose some significant judgments and assumptions made in determining whether or not an entity controls another entity, or whether or not an entity has significant influence over another entity. So that would be an example of a disclosure requirement required there. The second group of disclosures is specific disclosures, and in that group we've got commitments and contingencies, impairment, related parties and subsequent events. Okay, together with the framework we've got some rebuttable presumptions, and this helps us when we're looking at the cost-benefit principle. So the first rebuttable presumption is that the benefit of providing a disclosure that is a key disclosure area exceed the costs. So all those disclosures on the previous page, the assumption or the presumption is that the benefits will exceed the costs. However, that can be rebutted, and that is rebutted in circumstances where some specific disclosures give very little or provide very little incremental benefit because a similar disclosure is required elsewhere. So rather than requiring two lots of similar disclosure, one of them will be omitted for Tier 2 entities. The other rebuttable presumption is that the costs of providing a disclosure that is not a key disclosure area exceed the benefits. And similarly, this can be rebutted, and it's done in cases where, for example, the disclosure is providing information about the reporting framework under which the entity is reporting, or the structure of the group. So, for example, in FRS 44, you're required to disclose whether you're complying with NZ-IFRS or NZ-IFRS RDR. So that is telling the users of the financial statements which framework or which level tier of reporting you're reporting under, so we would retain that disclosure for Tier 2 entities. Okay, so to help us to actually apply that framework, we've also developed some operational guidance. And this deals with the areas on this slide. So firstly, sometimes we have to go through and make a judgment call on whether an item is a presentation or disclosure, because the RDR applies only to disclosure requirements, not to presentation. The assumption under the framework is that the face of the financial statements for a Tier 1 entity and a Tier 2 entity would basically be the same. And the only exception for that is where NZIS 1 requires a third balance sheet under certain circumstances. Tier 2 entities are not required to provide that third balance sheet. So although it's a presentation requirement, it is still identified as a concession. We also have some, we look at disclosure objectives and principles, and sometimes a paragraph says an entity shall disclose information to enable users to understand, for example, the nature and extent of share-based payment arrangements that existed during the period. That paragraph is then followed by some specific disclosure requirements for an entity to meet that objective. So in those circumstances, the paragraph requiring disclosures to meet an objective or principle are identified as concessions, but the specific paragraphs following them are then analysed to see which ones should be kept. We've also outlined requirements regarding guidance, and we'll discuss that a little bit later because it's a difference between the NZASB and the AASB. Sometimes a paragraph encourages an entity to make a disclosure. They're not required to be done by Tier 2 entities. Some paragraphs sometimes require reconciliation from an opening balance to a closing balance. Under the current RDR, those reconciliations are required, and the concession is that you don't have to provide the reconciliation for the prior period. And it doesn't matter that you've actually got the information anyway, you just don't have to do it. Under the new proposed approach going forward, reconciliations will generally not be required, but we will actually have a look at the components of the reconciliation, and a Tier 2 entity might have to make some of those specific disclosures. Cross-referencing, where the cross-referencing is specific, so for example, IFRS 3 business combinations includes a reference to paragraph 85 of NZIS 37. Paragraph 85 in NZIS 37 is a required disclosure by Tier 2 entities, so the paragraph in NZIFRS 3 that refers to paragraph 85 is kept, so that both paragraphs are either kept or they're both reduced. I'll deal with cross-referencing of a general nature a little bit further down the line. And then finally on this one, there are two standards that are not applicable to Tier 2 entities, and those are NZIFRS 8 and NZIS 33. And that is because those standards refer to entities that are listed or that are in the process of applying to list or submitting financial statements to be able to be listed, and Tier 2 entities are definitely, if you're in the process of listing or you're listed, you're definitely not a Tier 2 entity. Okay, so that deals with the proposed framework and the operational guidance, and although this is a joint project, the AASB and the NZASB have, in a couple of areas, come up with slightly different approaches. Although we've got these different approaches, it's expected that the outcome, or if a Tier 2 entity applied the Australian approach or the New Zealand approach, basically you would come up with largely the same disclosures. These difference of approaches that we've got are largely the result of differences in the financial reporting frameworks in Australia and New Zealand, because we've had, in New Zealand, we've had some form of differential reporting for many years and people have got used to it, whereas in Australia, some entities with the statutory reporting requirement don't have to do GAAP accounts. They can prepare what are called special purpose financial statements. And Australia has only had RDR in place since 2010. Okay, so what are these different approaches? So, firstly, there are three areas. The first one is disclosures about accounting policies, and the second one is about the guidance, and the third one is about the cross-referencing and standards, and I will look at those three in a little bit more detail. The other big difference is in NZIS 1 in paragraphs 19 to 24, which is dealing with the true and fair view override. And in Australia, there is still a legislative requirement for entities to comply in full with accounting standards issued in Australia, so entities are not allowed to depart from a requirement in Australian accounting standards. in New Zealand, when the Financial Reporting Act was issued in 2013, that requirement that was in the 1993 Financial Reporting Act was not carried forward. So because we don't have a prohibition on departing from an accounting standard, it's appropriate that we leave in paragraphs 19 to 24 so that if a Tier 2 entity does depart from a requirement in an accounting standard, the appropriate disclosures are made about that departure. So briefly, what are the differences in these three approaches? And you'll find all this information in paragraphs 51 to 72 of the ITC, so I'm just going to talk about them briefly here. The NZASB has decided that although there's a requirement in NZIS 1 to disclose significant accounting policies, all the disclosure requirements about accounting policies in other standards will also be kept. And this is to avoid any confusion that might arise because NZIS 1 says please disclose significant accounting policies, but for example in NZIS 2, if there's a disclosure concession and you don't have to disclose what is your measurement basis for inventories, a preparer could be looking at this and thinking, so which one do I do? Do I not do it for inventories because I don't think it's important, or do I do it because IS1 says I must? So the NZASB has decided that they will keep all accounting policies throughout the standards where they're needed. Now the AASB is going on a different approach on this, and they're relying on the general requirements in the equivalents to NZIS 1 and NZIS 8 to actually make the relevant disclosures about accounting policies. And their reason for this is that under the IFRS for SMEs it was like a standalone package, so therefore under RDR it's a similar position and it's almost a set of standards in its own right, so therefore you don't need to repeat all these disclosures. Feedback received in Australia also was along the lines of sometimes those accounting policies, it's just boilerplate disclosures taken straight from the standard. So really if somebody wants to know what they are, you could arguably go and look at the standard. So there is a difference in approach there. And this also has an impact on the identification of the disclosure requirements for Tier 2 entities, and I will also just discuss that a little bit later. We also have a different approach regarding guidance, where the guidance is of a general nature. The NZASB has decided to keep all the guidance paragraphs, so there's no confusion. The AASB has decided that sometimes the guidance is very general in nature, and arguably the disclosures, the standards they're referring to, the entity would have to look at anyway. So for example, a paragraph in NZIFRS 16, there's a paragraph that requires a lessor to apply NZIS 16 to property, plant and equipment that is subject to a lease. So that is regarded as not being necessary for a lessor to be able to apply NZIS 16 because they would apply it anyway. So in those sorts of circumstances, the AASB has decided to actually reduce those paragraphs for Tier 2 entities. And the other difference is with the cross-referencing and standards, and the guidance and the cross-referencing here is probably quite similar, where the cross-referencing is of a general nature, and it says, as I've just given an example in NZIFRS 16, it's very general. So in those circumstances, the AASB would actually not require would actually reduce or that paragraph for Tier 2 entities. Okay, now just for anybody who's joined late, just want to remind you that the slides will be available and a webcast will be available tomorrow. Okay, this is probably one of the most important things, as everybody says to us, okay, so what's going to be different? Can you quantify the difference in the disclosure requirements for me currently versus what's coming up if these proposals go through? Now that's actually quite hard to do, and what we need to bear in mind is firstly that some of these disclosure requirements are different, so therefore they're difficult to quantify. So for example, if you're a Tier 2 entity and you haven't adopted NZFRS 9 yet, you are likely to have quite a lot more concessions going forward because you will be picking up fewer disclosures than an entity that might have adopted NZFRS 9 early. And although we did do RDR for things like the hedging requirements and expected credit losses, we don't know how many entities have actually picked up NZFRS 9 early and therefore taken advantage of those concessions. So it's very difficult to actually quantify what is different. Some RDR paragraphs will be deleted because they're no longer required, but there might also be additional RDR paragraphs because we're giving more partial concessions. If you have a look at the exposure draft, you'll see that some concessions are being removed. This doesn't necessarily mean that an entity will have to make more disclosures. Some of those concessions that are being removed will fall within what we deem to be guidance, and some of them might be presentation rather than disclosure. So if we add those paragraphs back, it doesn't necessarily mean that an entity has to do more disclosures. And finally, what we need to bear in mind is that there are no reconciliations, but more individual items might need to be disclosed. Now, what we've tried to do is just give an idea or a bit of a flavour to where the substantial reductions are, where there's no change, and where possibly the disclosures are about the same. And just to put a health warning around this one, whether there are substantial reductions depends on whether those standards, those 5 standards listed in the blue box, actually apply to an entity. So this is going to vary from entity to entity. In the green box, there are 3 standards and 1 interpretation where there are no changes to the current RDR, so those standards and that interpretation are not included in the exposure draft. Just to provide some examples at a very high level of where there are substantial reductions, or in, for example, IFRS 7, I'll do IFRS 7 later, so it's on the next slide, but for example in IFRS 12 there are more disclosures around significant estimates and judgments because it's a key disclosure area, some around the changes in the status of an investment entity, and some around interests in unconsolidated structured entities. We've actually removed a couple of concessions relating to interests of non-controlling interests and the nature and extent of significant restrictions and the nature of risks associated with interests in unconsolidated structured entities. So you'll be able to see that from the exposure draft, and also from, there's a staff analysis that accompanies the exposure draft, and I'll just talk about that a little bit later. So on this slide, just because NZ-IFRS 7 as NZ-IFRS 7, I've just tried to give you an idea of the area where if you have already applied NZ-IFRS 7, we would be removing some of the current concessions. So there will be, the concessions being removed are basically in respect of the financial instruments at fair value through profit and loss, and the nature and extent of risks arising from financial instruments. There are quite a lot of additional concessions in NZ-IFRS 7, and I've just listed those areas at the top, so I'll leave that for you to have a look at. Now, the approach to identifying RDR, the NZASB has decided to continue with the current approach, so we'll use an asterisk to identify a paragraph that a Tier 2 entity doesn't have to comply with, and we'll put in RDR paragraphs for partial concessions. Now, the AASB is proposing what we call an appendix approach. So currently in Australian accounting standards, the disclosure concessions are shaded in the accounting standards. What the AASB is proposing to do is put a specific Australian appendix to each standard, and that standard will list the disclosures that a Tier 2 entity is required to make. And Appendix B of the invitation to comment gives you examples of that approach, and for NZ-IFRS 16 leases and for NZI's 38 intangible assets. Now, because the AASB is going to rely on its equivalent standards to NZIS 1 and NZIS 8 for disclosures about accounting policies, there's going to be a paragraph at the top of each appendix in the standards that reminds entities that they need to look at AASB 101 and AASB 108 for disclosures about accounting policies. Okay, so why am I sitting here telling you all of this? We are seeking some feedback on all the points listed on this slide. So we're seeking feedback on whether you agree that the overarching principles of user needs and cost benefit are appropriate. Have we got the right key disclosure areas? Is there something missing, or should we add some, or should we leave something out? Does the framework and the operational guidance as a whole work? Now, to help constituents to understand this, in addition to the invitation to comment, there's an exposure draft which is 122 pages long, but we've also prepared a staff analysis where we've got all the disclosure requirements in NZ-IFRS, and we have applied the framework to those disclosure requirements to work out what are appropriate disclosures for Tier 2 entities to make. Now, that document is just over 350 pages long, so we don't expect you to sit and read every page. Some people might want to. Thank you, we really appreciate the feedback on that. But you might find that, oh, I want to know my entity's got, or property, plant and equipment is important to my entity, what is going to change? So if you have a look at the section of the staff analysis dealing with property, plant and equipment, it's done in 3 columns. So it shows you what are the current disclosure requirements in full NZ-IFRS and what are the RDR currently. So what is not required at the moment is shaded. In the middle column, we show you what the proposals will be going forward based on the decision-making framework that we've applied to those. And in the 3rd column, we give you the rationale for arriving at the decision we arrived at. And then the outcome of that analysis is what is shown in the exposure draft. So the exposure draft has, as is normal in New Zealand, shows what will be changing. As mentioned earlier, the effective date is 1 January 29, and I encourage you to have a look at the detailed proposals in the exposure draft. And just to remind you that the invitation, that comments are due by the 26th of May. The documents are available on our website. That's the invitation to comment and the exposure draft and the staff analysis. The Australian, equivalent Australian, submissions are also due on the 26th of May, and their documents are available on the AASB website, aasb.gov.au, if you want to have a look at what they've done. We don't, if you don't want to answer all the questions, that's fine, but if you really feel strongly about something, we really would appreciate your feedback on our proposals. And just to remind you all, we've got a new website. So this slide is taken from the accounting standards, and you can see it's highlighted in bright blue at the top. There's a button on the right-hand side for current exposure drafts. There's a little thing about the standards in development where you can find exposure drafts, and the ones where the comment period has closed, we have the exposure draft and the submission letters received. And if you want to keep up to date and you're not on our mailing list, there's a little box at the bottom for you to complete. So I'd just like to thank you once again for joining us this afternoon, and I'd just like to remind you again, the slides will be available tomorrow together with a recording of this presentation, and we look forward to receiving your comments on these proposals. So once again, thank you very much for joining us, and enjoy the rest of your day.